So what's a strangle and why would you do it? And what is that crazy looking chart behind me? Let's find out. Let's say you've bought 100 shares of some stock. You believe it's currently priced below its intrinsic value. So you're thinking of buying some more. You'd also like to make a little extra cash by selling some covered calls against your existing position. Now this is a perfect setup for doing a strangle. Here's Investopedia's definition of a strangle. An option strategy in which the investor holds a position in both a call with a higher strike price and a put with a lower strike price, but with the same expiration date and underlying asset. This definition of a strangle is a little more strict than I use. I don't require my expirations to be the same on the puts and calls of the strangle, and I don't require the same number of contracts. However, I do make sure the call strike price is higher than the put strike. At the start of the strangle, they box in or strangle the stock's current price. I'll show this graphically in a bit. We're just going to talk about short strangles, which means you're selling both the calls and the puts, but you're long on the underlying stock. The strangle strategy I use as a long-term investor is: first, keep the calls conservative. Set their strikes well above the underlying stock's current price in the beginning. Open them at around 15 delta to give yourself some room for price appreciation. And if the underlying moves up near to the call strike price, be ready to roll up and out. Second, be aggressive with the put strike price. Set the strike just below the current price of the underlying stock, because you want to buy more of this stock you're strangling. So look for a delta around 40, which will have a strike just below the underlying's current price. I start thinking about strangling in this situation. I've been assigned on a put and have my initial position. Then I'll sell covered calls on that position. And then the stock falls further. But I still like the stock. Nothing significant about the company's long-term prospects will have changed, and the reasons I bought it are still in place. At that point, consider selling more puts to build out your position, which results in a strangle. Strangles can be fun and lucrative because you're making premium on both puts and calls. You can lower your cost basis much faster than just using covered calls alone. But be careful. You don't want to be strangling the stock of a bad company on its way down to bankruptcy. So make sure you're strangling the stock of a good company with a good future, and be confident that that stock is going to rebound at some point. And your strangle will have the downside and risks of both selling puts and selling calls. Now let me show you an example of a strangle I currently have on. It's for CVS, the big drugstore company. But first, if you're enjoying this content and want to learn more about options for long-term investors, please like and subscribe. I'm strangling CVS because I think it's a solid business with good long-term prospects. I like that they're investing in on-site healthcare services. I like their dividend, and it appears to be safe. I believe their free cash flow can service their debt and pay it down over time. And I think it's selling for a bargain price. So I'm strangling it. Here's a graphic representation of my strangle. The purple line represents my 2 covered calls I have open. I opened them on May 4th. May the 4th be with you. At an 80 strike. They expire in August. I opened these when CVS was pretty close to its current price. And I just sold a put a couple days ago, and I set the strike at 65, just below its current price. And it expires in July. a month before my calls expire. So the strangle is going to be active from June 14th to July 21st. And as long as CVS stock price stays between 65 and 80, I'll just collect all that premium from both the put and the call. Not a bad outcome. It would be better if CVS stock went up to 80 and even beyond it. So then I could roll these covered calls up and get a lot of price appreciation and collect all the put premium. Now the worst outcome is if CVS stock goes down below 65. But even in that case, I get to lower my cost basis by buying more, 100 more shares at 65 strike, and collecting the call premium. Here's a spreadsheet I use to track my positions, and I'm showing my CVS call and my CVS put. My cost basis for CVS is just over almost $82, so I'm underwater. When I opened those two covered calls, I got $129 premium, and it's been slowly decaying away. After 45 days, I've realized 83 of that 129, and I could still realize another 46. If I realized all the premium, then that's a 3.28% return on the 13.5 collateral. Through 45 days, I've actually made almost 5%. And 61 days left, I could potentially make another 2% if this goes all the way down to zero, which it probably will. Now my put, which I haven't factored into this cost basis yet, the strike's at 65, and I made $124 premium on that one put. On just one contract for like 1/3 of the duration, I made almost as much premium on the put as I did on the two covered calls. So the put premium is at a higher yield than the call premium. I only opened that 4 days ago, and I've already realized $31. So I've been making 43.5% on that. With 33 days left, I can still make almost 16%. And when I originally opened the put, if I realized all the premium, that's going to give me almost a 19% return, assuming it expires worthless. And the collateral is 6,500. That's how I'm calculating these yield numbers. I love Strangles. I feel like I'm getting double the premium, and I'm lowering my cost basis at a quicker rate. But don't be fooled into thinking they're foolproof. You can get hurt with Strangles, just like you can get hurt buying a stock outright or selling a put on a falling knife stock. And you can miss out on significant stock price appreciation with the covered call part of the Strangle. Hopefully this YouTube helped you understand these risks and benefits. I've linked a couple of my other YouTubes related to this content in the description if you'd like to see more. Please consider liking and subscribing if you found this useful, and let me know what you think in the comments.